Amin Reina here from Sage Investors, and this is take number 19. Wow, lots of stuff, lots of moving parts going on in the markets, both in the stock market and the bond market and the commodity market and almost in the geopolitical domain. And they're all kind of like running into each other. And so I thought I'd jump on here and let's try to figure out what this all means, and at the end of the day, what this all means for stock prices going forward, and what this means for in terms of investing opportunities going forward. So right now, we're sort of in a situation right now where the markets are digesting. You might say they're transitioning, recalibrating all of their assumptions and pricing in terms of figuring out how to price assets in a world now that appears to be talking about higher interest rates, slow to moderate growth, and inflation that's sticky. That's kind of where we are right now. Up until now, a lot of the smart money people, Wall Street, Bay Street, all those smart money people have essentially been covering their ears about all of this stuff that's been going on, and are now starting to come to grips that, you know what, I think we've screwed up. They've made a mistake. This is a group of people, if you just go back the last few years, I'm trying to go back a little bit to get to where we are now. This is a group, people that have been pounding the table. These are the people, institutions, all the wonderful people, you see splashing on the business media, who have been pretty wrong about a lot of things. And, in fact, it's cost investors quite a bit. First of all, they were wrong about this whole inflation thing. In their mindset, they thought inflation was transitory. Remember that word, transitory? You couldn't go away from it. Even the central banks were all about transitory. Inflation was temporary because of the pandemic. Oh, when the pandemic stops, everything will go back tickety-boo. Well, guess what? Didn't happen. And it's interesting because Wall Street and Bay Street, when they realized that this is not going to happen and inflation is going to stick around for a while, they didn't do a mea culpa. They just said, oh, it's the Fed's fault. They led us the wrong way. Well, no, not really. It was on you. So that's one thing. Second thing, there's a group of people, Wall Street, Bay Street, pounding the table that right now, as where we're sitting right now, we'd be in a full-on recession, mid-2023. Like at the start of the year, this is all we're hearing. Recession, it's coming. Oh, yeah. And it was casual. Oh, yeah, when we hit the recession in the middle of the year, we'll go through there and everything will be fine. And then that built on that narrative, again, which was wrong, which is this whole notion of a soft landing. You kept hearing about soft landing. Oh, we'll bypass all the bad things and all the disruption and all the problems with inflation, and we'll just pretend it never happened, and we'll just land nicely and we'll keep going. Well, that's not happening. The data is showing that we're walking right into one. And then again, they were wrong. They were saying at this point, we're going to be seeing interest rates start going down. Well, check out the 2-year, the 5-year, the 10-year, any year bond, and they have been going up, and they've been going up quite a bit in the last month or so. Incredibly accurate track record of being wrong. And that's where we've come from. And this is where we are. And the question I keep asking myself is, why do we continue to listen to these people? And they're consistently wrong. They're very smart, very educated, learn all a lot of things, but they're very wrong about all of this stuff. It's just, this is what it is. So what's the reality right now? The reality right now is we have inflation. Inflation has come down, but it's sticky. It's not going to just go straight down to 2% like the central banks are, been pounding the table for. If you've been following me and listening to, my previous posts and takes, my take on this is inflation is coming down, but it's going to settle at a higher rate than we've been normally used to. I think 2% is just like a made up number. I don't think it's real. I think the reality is we're heading back to a more historical norm of inflation, which is probably 3 to 4%, which is kind of like where we are right now. So why are we going to go like that? Why are we not going back to what, central banks think we should be at? Well, we're in a different world now. We're in a world now, and a lot of it is pandemic driven. The fact of the matter is the pandemic was an aha moment to realize that, for companies and businesses, that we cannot put all our supply chain distribution network and trade elements tied to one region of the world. We need to diversify. We need to expand on it. We need to localize and regionalize our supply chains. The whole concept of just-in-time inventory clearly blew up during the pandemic. And now it's more about keeping inventory, warehousing, and those are costly. Those are inflationary items. This is not cheap stuff. So that whole transition is underway. It's happening. We're seeing what's happening in China with a lot of that reality, a lot of that foreign direct investment that has historically been going into there in the last 20 years as Western companies going in there and building up things, taking advantage of all that, the economies of scale have just blown up. And now there's a whole rethink and a recalibration going on there. For God's sake, Apple is like rethinking its whole concept. And that's China is their bread and butter for this. And they're rethinking the whole thing. Then you got the whole climate change thing. The reality is we're going to be transitioning. We need to transition into more efficient tools and technology that doesn't hurt the planet. If there's anything, the pandemic reinforced the fact was a timeout. I think it was Mother Nature's way of giving us a timeout and saying, you know what, you're hurting the planet. Get your shit together. So that's keeping that. All these elements are probably going to keep interest rate inflation a little bit higher than what central banks would like it to be. And right now, they don't seem any interested in adjusting those targets. They are going all in on a 2% inflation target. And if that means what that means is maybe keeping interest rates higher than what they normally should be. So what's the take? What's the take on this? Higher interest rates. So if interest rates are going to be higher, what does that mean from an investing perspective? Higher interest rates mean higher costs of capital. So when you're valuing companies, you're valuing stocks, you're valuing businesses, you're looking at higher costs of capital tend to lead to lower asset values. Higher interest rates also lead to higher capital costs, which can potentially, if you're a business and a company that has to borrow money to finance the running of your business, it's higher interest payments. That's going to take a shot on your earnings, and ultimately lower earnings feed into lower asset prices. So that's the environment we're kind of into. We're into an environment where we could be heading into a much more moderate growth or a tepid growth in asset prices, especially in stocks, equities. What's interesting right now is, all the data, if you look at all the data and everything seems to be slowing down. Right. Are we going into a recession? I have no idea, but we're slowing down. And usually in that period when we're getting slower growth, slower employment, in that kind of environment, that's usually where bond prices or bond yields should be, flattening out or even tracking downward. But we're getting the opposite. Now, that's creating a lot of, head scratching going on right now. Like, why are bond yields going up? I have an answer. Basically, inflation is a factor here. Inflation staying higher for longer is probably going to drive them into it. But there's also right now some very unique things that are happening right now, and it has nothing to do with economics or inflation. It has really to do with supply. And if you recall, earlier in the year, we had this whole issue in the US with all the debt ceiling things. The government was going to shut down. It's interesting. The government's looking to shut down right now again. But before, the issue was the US government was not allowed to issue debt. They reached a point where they had reached the limit of amount of debt they could issue. And that started the whole chain of events that led to all the debt ceiling crisis. And so because of that, the US government wasn't issuing a lot of debt. So obviously, fast forward, if things got resolved and, a lot of arguing and everything like that, they resolved the issue. But what that left a void in the US government coffers in the sense that they needed to go out into the bond market and issue new debt to run the government. And so that's what they've been doing. And they've been doing it a little bit on steroids, not the normal operating procedure is just issue a little bit of debt and bonds slowly, but because they were so behind the eight ball, because they had gone such a long period without issuing new debt, they had to do like a whole big bulk issuance. And so what's been happening over the last while is the US Treasury has been going to market issuing debt putting new debt on the market. And so normally, because it's the US debt and it's, the gold standard, it's, AAA, well, it's AAA, high quality, low risk, debt, it shouldn't be a problem finding people going out and buying it. Well, the problem is the last few months, and there hasn't been the same level of buying interest for US debt. The normal players that normally enter the bond market and scoop up all these new issuances, they just really haven't been there in like they've normally been. Who are those people? Well, China. China is a big owner of US treasuries. We all know they've got issues right now. They've got a lot of economic issues going on right now. And instead of putting their money into US treasuries, they got to start cleaning up stuff over there in their own country. So a lot of money that would have been funneled into buying US treasuries is now going. If you look at the data, the amount of US treasuries that China owns has been tracking down quite meaningfully over the last year or so. So China hasn't really been in the market. Banks, earlier in the year, remember all those issues with Silicon Valley Bank, and we talked about it here on In the Loop. All the deposit issues, bank issues, running solvency issues. They're normally in the market buying some of this stuff, but they're not around because they're trying to take care of their balance sheets right now. So these are two elements. And then the third element too is the central banks themselves, the Federal Reserve. They have been out, the news headline, what we see is about interest rates, but behind the scenes, the Fed has also been doing a lot of monetary policy, operational kind of things to reduce the amount of money that's in circulation. Up until, really till last year when they started increasing interest rates, the Federal Reserve has been issuing a lot of bonds, have been printing a lot of money. Over the last year, they've been starting to slow that down because they obviously feel there's too much money out in the market and it's just inflationary. So, what they've been doing now is instead of when bonds are starting to come, when US treasuries are starting to mature, they're basically not going back in and issuing more bonds. They've been retiring them. And so essentially we see the Fed's balance sheet, the amount of cash that they're generating has been falling down. All of these things, where I'm going with all of this stuff, is ultimately, if there's less people buying these bonds, that means those bond prices are going to fall. And ultimately, when those bond prices fall, it's an inverse relationship with yield. You get to higher yield. So that's right now a very kind of back office, behind the scenes element of what's going on that's keeping interest rates right now. And in a backdoor way, it's actually helping central banks, because if yields stay high, then there's really no incentive for the Federal Reserve or any central bank right now to increase interest rates, increase short-term interest rates, if the bond market is kind of doing the dirty work for the central banks. So a lot of people talking about, oh yeah, where interest rates are going to go, oh, the Fed's going to hike one more time. They could, but if bond yields keep going up the way they are right now, maybe they might back off. I wouldn't be surprised if they just back off and just say, you know what, I think we're good right now. Let's just let things play out. So we've got right now, the markets are going through, I've been talking about this for a while, but it looks like it's really now starting to get underway, where we're talking about a whole recalibration. Now, the market is just totally recalibrating, resetting itself to figure out how to operate in a world which is inflationary, which has higher costs of capital, and potentially could have slower rates of growth. And so companies, the banks, companies themselves now are looking at their capital structure. They're looking at their cost centers, their cost profiles, and looking at how to make things a little bit more efficient. And unfortunately, it can be a very painful process, and it can be a very hurtful process, because that could lead to cost reductions, more job losses, unemployment, those kind of elements. So this is the recalibration that's underway. So the question we have right now as investors, is this recalibration going to be a very slow grind? Or are we looking at a point where we could get a 1987 moment where the market's just like one day out of nowhere, just say enough, I can't be holding stocks anymore? Because that's the reality we're in right now. the question you have to ask ourselves, and I ask myself, is why, with interest rates, you can get a 6 month T-bill for like 5%. You can get a 1 month, a 1 year T-bill for like 4.5, 5.5%. You can get short-term money that's going to give you almost near equity level returns for a lot less risk, hardly any risk. So the question is right now, why do I want to own stocks? And I think that's what the question the market is starting to digest is, why do I want to own stocks when I can get near equity level returns at a much lower risk profile? And so this is the question, is this going to be a slow grind, or is this going to be like a rip the band-aid moment where people just say enough and I'm heading to the exits, and then all of the dominoes start falling? So that's a short-term question, a lot of people are asking. And as I said, right now, I'm asking the same questions. And the reality is, I look at where I am right now, I've never owned as many bonds as I have as my, fixed income as I have in my entire career being as an investor than I do have right now. It's weird. And I'm recalibrating and trying to reconcile all of this in the short term. In the medium to long term, what am I thinking in the medium and long term? Well, the medium and long term is, at some point, rates are high right now, but at some point they're going to plateau, and at some point they're going to track down. And so from a bond perspective, if bond yields are peaking and bond yields start to grind down lower, then that's going to create opportunities to get capital gains in bonds, because bond prices are going to fall. So if bond yields fall, then bond prices are going to go up. So there's opportunities for capital gains. And so again, I've been doing this for almost 20 plus years, and I've never seen a period right now where bonds actually look like a better opportunity for capital gains than stocks. And so yeah, I'm looking at bonds. I'm disclosure. I do have exposure to bonds, and it's playing on this narrative, this medium to long-term narrative. It's a painful narrative right now because yields are going up, so my returns on my bonds are lower. But at some point, and again, I have no idea. I'm not even going to call it or try to figure it out. At some point, rates are going to start tracking down, and at some point, there will be benefits and opportunities to profit from it by holding bonds and fixed income. Also, when we get to that point where rates start tracking down, that will probably be an environment where we will probably see a lot slower growth. Potentially, we might see a recession, or just see very flat kind of, growth, GDP growth. And that could freak people out. And as people are freaking out and throwing their stocks out, we could get a situation where a lot of assets start getting thrown out with the bathwater. And so, as I said, at the end of the day, the best long-term investment out there is holding equities. It's the way will continue to be that way. And so, as much as I'm kind of nervous about why I want to own stocks right now, at the end of the day, I'm an investor, and I'm always wanting to have exposure to the stock market. So at some point, we could start seeing some really interesting opportunities come up on the equity side. And so I'm keeping doing a lot of my homework right now, trying to find what those plays are, and the easiest way to find out what those plays are figure out what's not doing well. And that's pretty easy right now, because ultimately, through all of this, we've had about 7 companies, the magnificent 7 tech companies, driving the whole equity market. And so that ultimately means there's a lot of undervalued, underutilized stocks out there that are going to probably be very interesting investments in the medium to long term. And so that's the place to start looking. And so where are those places? I'm looking at banks. Banks haven't been getting a lot of love. Utilities haven't been getting a lot of love. Luxury retail is now starting to track down. And so it's going to get to a point where it's going to start having some interesting opportunities. If you really want to go contrarian, and this is something for me, like a long-term speculative kind of thing, it's commercial real estate. Because, my take on it is, at some point, once the fog of COVID lifts, I think we're going to see a mass return of people into an office environment. And these are the places that are going to value. Right now, they're depressed as hell. But at some point, again, no idea when, it could be an interesting contrarian play. So that's kind of a little bit of a synopsis about where I think things are. It's a very, very messy environment right now. Inflation, the markets, interest rates going up when they shouldn't be going up. A lot of interesting. So hopefully I've been able to kind of highlight some certain things that give you a little bit of focus and trying to and helping you frame your decisions going forward. As always, do your homework, do your research. These are just my takes, and this is just what I'm seeing. And as like one of the things about investing, and as I talked about earlier, it's very easy to be wrong. So have a plan, have a playbook, and have an exit strategy for when if those mistakes occur. That's the one way that leads to actually long-term wealth, is managing your losses. That's all I got for you today. If you want to follow more of my takes, you can find me on my website, sageinvestors.ca. I have a lot of information also about the courses that I teach and also my coaching services. I'm still on the Bird website, but not really as much now. I'm kind of putting more of my takes and more of my observations and sharing content and stuff like that through the threads. Now you can find me through, just do a search for Sage Investors Nation. I'm also posting a lot more of my takes and a lot more of my observations on my company Facebook feed and also my LinkedIn company feed. So you just do a search at both of those places for Sage Investors, and you can find me there. Please feel free to join up, jump in, offer some takes, and love to hear from you. So that's all I got for you today. That's been another episode of In the Loop. My name is Amin Reina from Sage Investors, and we'll catch you again another time. Take care. Bye-bye.